Hi students, welcome to Sunil's tutorial. I am Sunil Nirvani and today we will be doing this chapter called as capital budgeting. Let's see question number 4. Question 4, page 335. They give you that a company is purchasing a new machinery and will carry out some operations presently performed manually. The alternative models are given as giant and pygmy. The following relevant information is given. Now the first thing you need to check is tax rate given to you. Let's see the closing paragraph. They said that the company is liable for income tax at the rate of 50%. Since tax rate is given to you, the first thing you will do is find out depreciation. Depreciation is given by the formula cost minus scrap upon estimated life. They've given you two options. One is giant and the other is pygmy. Okay. Now the cost of the machinery is given to you as 1,50,000. They haven't given you scrap value. Life of the asset is 5 years. In the second case, the cost of the asset is 2,50,000. Scrap value is not given to you, and this is 6 years, right? So you should be able to get the depreciation 30,000 here, and 6 4 are 24, 41, 666. We'll take that as 41,667. Next, let's calculate your cash inflow, for which first let's find out additional saving. Let's find out additional savings. Now in additional savings you have savings in indirect material. Indirect material 6,000 and 8,000. Then you have savings in scrap. Savings in scrap is 10,000 and 15,000. Then they give you employees not required, 15 and 10, and wages per employee. So you are going in for retrenchment of employees. You are removing employees. The salary that you are going to pay them is going to be saved now. So this is wages saved. Now in the case of giant company, there are 15 employees and their wages per employee is 6,000. Someone please do this. 75,000. Someone please cross check. 6,000 into 15. 90,000. Next. And in the next case it is 6,000 into 20. Someone please do this. 1,20,000. Right? So these are your savings. Next. That will give you your total savings. Next, additional expenditure. Additional expenditure is given to you as cost of maintenance. Cost of maintenance is given to you as 7,000 and 11,000. 7,000 and 11,000. Next, additional cost of supervision. Cost of supervision is given to you as 12,000 and 16,000. Right? That's it. Those are the various things given to you. So you will get here B. In that case, you have additional saving, additional expenditure. You will get profit before depreciation. Profit before depreciation is A minus B. Someone give me the totals. This is going to be 1,06,000. This is 1,43,000. 19,000. And this is going to be 27,000. Someone please do this.
27,000.
The first one. Second one. Someone please get this. Someone please subtract and get that answer. 1,60,000. Right? Now, after this, you will say that you less your depreciation. So depreciation is 30,000 over here, and it is 41,667 over here. So you will get your profit before tax. So this is going to be 57,000. Someone please subtract this. This one, next one. 74,333, right? Less tax. Now the tax rate is given to you as 50%. 28,500.
37,166.5. So 67 million.
So in which case you will get PAT, profit after tax, which is going to be 28,500 and 31,166. Right? Add back depreciation. If I add back depreciation, depreciation is 30,000 here, and depreciation is 41,667 here. Right? This will give you your cash inflow. This will give you your cash inflow. Once you have your cash inflow, that's 58,500. And someone get me this.
78,833.
78,833. Okay. Now, once you have your cash inflow, then you can find out your payback period. Payback period is original investment divided by annual cash inflow. So in the case of Giant, your original investment is 1,50,000. Your cash inflow is 58,500. In the case of Pygmy, your investment is 2,50,000 and your cash inflow is 78,833. Someone please get me the
2.56.
2.56, and in that case 3.17, right? That's your payback period. Once you have your payback period, then you can find out your payback profitability. Payback profitability is nothing but cash inflow into estimated life minus payback period. Right? Cash inflow. Cash inflow you just found out is 58,500 into estimated life is 5 years minus 2.56. Right? In the other case, your cash inflow is 78,833. Right? And your life is 6 years. Payback period is 3.17. Someone please do this.
1,40,400.
1,40,400. The next case. It's 1,42,000. Sell 40. 1,42,000. Sell 40. Okay, and the next one.
2,22,000. No, sorry. 223097.
223097. Okay. Now guys, here we have a problem. If they say, how do I select which machinery? Now if you see, the payback period of machinery Giant is less. So on the basis of payback period, you have to select Giant. But if you look at your payback profitability, the payback profitability of pygmy is more, and hence pygmy has to be selected if profitability is considered. So your conclusion, if payback period is considered, then giant should be selected. If payback profitability is to be considered or is considered, then pygmy should be selected. And do we get this in there? So these are your two options, right? This finishes the sum. We'll stop this here for the day. Thank you very much.